So if you're a long-term investor, maybe thinking about adding Bitcoin to your retirement account, these new spot Bitcoin ETFs are a total game changer. But man, with so many choices, there is a serious fee war going on. In this explainer, we're going to cut right through all that noise and focus on the one thing that truly matters for your long-term growth: the cost.
Okay, so let's just start with a really important question. Seriously, the answer could be worth thousands, maybe tens of thousands of dollars to your portfolio over time. See, with these new funds, the cost isn't some bill you get in the mail. No, it's way more subtle than that.
The big concept you really need to get your head around is called fee drag. Now, unlike a regular stock fund that might take fees from a cash balance, these spot Bitcoin ETFs are designed to hold pretty much only Bitcoin. So, to pay their bills, management, operations, they do something incredibly simple. They sell a tiny, tiny fraction of the fund's Bitcoin every single day.
And this is the perfect way to think about it. The daily cost is so small it's basically invisible, totally lost in Bitcoin's normal price swings. You won't notice it tomorrow or next week, but that little shaving happens every day, and like any small persistent cost, it compounds. And this is where those microscopic shavings really start to add up. Let's say you own shares that represent about half a Bitcoin. After just 1 year, a pretty standard 0.25% fee costs you about 0.0014 BTC. I know, it doesn't sound like much, right? But wait, after 5 years, it's 0.007 BTC. And after 10 years, a full 0.014 BTC has just vanished from your account to pay fees. And think about this. If Bitcoin's price skyrockets, the dollar value of what you've lost skyrockets right along with it. So what does this actually look like in the real world? Well, when these funds launched, it was an all-out brawl over fees between financial giants like BlackRock and Fidelity. And this isn't just about tiny percentages. It's a battle to capture a massive new asset class and lock you in as a customer for decades. They are all fighting for your investment dollars. This table just lays it all out. On the super cheap end, you've got players like Franklin Templeton, Bitwise, and even Grayscale's new mini trust with fees well under 0.20%. Then you have the industry titans, BlackRock's IBIT and Fidelity's FBTC, and they've settled at a very competitive 0.25%. And then you have the outlier, Grayscale's original trust, GBTC, with a legacy fee of 1.50%. That is 6 times more expensive than the big guys. Now, fees are one thing, but size is another story. This chart shows who's really winning the war for actual assets. BlackRock's IBIT is the undisputed heavyweight champ, controlling a massive chunk of the market. Fidelity's FBTC is a very strong number 2. So why should you care about this as a long-term holder? Because higher assets under management, or AUM, almost always means better liquidity. It's just easier to buy and sell without moving the price, and that's absolutely crucial for a stable investment.
So here's where it gets really interesting, watching how the market adapts. Just look at Grayscale. Their original GBTC fund was the only game in town for years, but its massive 1.50% fee caused an absolute stampede for the exits the moment cheaper options arrived. To stop the bleeding, they were basically forced to launch the BTC mini trust with a rock-bottom fee of 0.15%, pretty much creating a lifeboat for investors who are fleeing their own expensive product.
Okay, so we've got fees on one hand and asset size on the other. But how do you combine those two things to figure out which fund offers the most bang for your buck? Well, there's actually a pretty simple metric we can use. It's called the return-to-fee ratio. All you do is take the fund's annual return and divide it by the expense ratio. This tells you exactly how efficiently your fees are being turned into performance. The higher the number, the harder that fund is working for you. Simple as that. And when we actually apply this to the two market leaders, IBIT and FBTC, look what happens. They both have that same 0.25% expense ratio, and since they both just track Bitcoin, their performance has been almost identical. So what happens? The return-to-fee ratios are virtually the same. This tells us that from a pure cost efficiency standpoint, these two giants are on a totally level playing field. All right, we've gone deep on fee drag, we've mapped out the fee war, and we've calculated the efficiency. So how do you pull this all together and make the right call for your long-term retirement portfolio? Here are the key takeaways, your personal checklist. First, and most importantly, focus on that final long-term expense ratio. Remember, small differences compound into big ones. Second, ignore all those flashy temporary fee waivers. They're just marketing gimmicks. The number that really matters is the one you'll be paying for the next 10, 20, or 30 years. Third, think about liquidity and trust. Big names like BlackRock and Fidelity bring a level of stability and high trading volume that can be a real deciding factor. And finally, for long-term holding, just stick with the spot ETFs. They own the actual Bitcoin, and they're way simpler and more cost-effective than their futures-based cousins. At the end of the day, the goal isn't just to get exposure to Bitcoin. It's about keeping as much of your own returns as possible. A low fee is the best friend you can have in the world of compounding. So the final question is really for you. Now that you know about these hidden costs, which one of these structures best aligns with your vision for the next decade and beyond? Answering that is the key to winning the long game.